Rich people, brokerages, banks, crypto whales, they all have multiple ways of making money. But the one that I'm going to show you today is one that is almost risk-free. And all of these smart traders, especially traders with huge sums of capital or brokerages even, they use this method to make money and to protect themselves while making this money. So today, this video is going to be about this, which is arbitrage. Welcome back to another video. We haven't seen each other in a while. You can see new studio here, new office. But before we jump into the nitty-gritty on how you can make money, we have to understand what the hell is even arbitrage. Almost everything that is considered smart money, meaning that these investors, these brokerages that have huge sums of money, they have huge portfolios, they cannot just go and dump all of their money into a single stock or into a single strategy, because that would be market manipulation. If all of their money was invested into one thing, or huge sums of money was invested in only one thing, that would be really bad for everyone else, all the retailers. So how do they actually move that money around? How do they profit with these huge sums of money? You should know by now that the larger your portfolio is, the harder it gets for you to make more money, because it will be harder for you to double your money if your money is like $10 million, or even for you to make 50% on that $10 million with the stock market or even with crypto, because there is no place for you to put all of that capital all at once. So you have to fragment your portfolio and invest a little bit here, a little bit there, and hope that one of these investments will be the one making 10x, 11x, whatever it is, to grow your overall big portfolio size. So this is why bigger portfolios, bigger firms with more money, they have smarter ways to invest this money. They use more advanced techniques, they use more advanced strategies, they use derivatives, and this is what we're going to be talking about today. Arbitraging is one of these advanced strategies for a couple of reasons, because it is a more complex strategy. I'm going to show you just one type of arbitraging here today, but there are plenty of ways where people can arbitrage. So if that's something that is interesting to you, I might cover other forms of arbitraging here in this channel. So I went online, and this right here is the best definition of arbitraging that I could find. And it says, arbitrage means taking advantage of price differences across markets to make a buck. If a currency, commodity, or security, or even a rare pair of sneakers is priced differently in two separate markets, traders buy the cheaper version and sell it at the higher price to make money. So if you want the TLDR version of what I just said, it is basically you're flipping. Most likely you've seen shows of people flipping houses. Most likely you've seen YouTube videos of people flipping sneakers or flipping phones or flipping cars. The act of buying the same product for cheaper somewhere and selling it to another market for a higher price. Arbitraging in layman terms is just flipping one product. But what is the product that we are going to be flipping? Well, this is what we're going to be focusing on today, which are derivatives. Mainly options. So how do you flip options? If you don't even know what options are, mainly crypto options, I'm going to point you to two directions right now. You can go in the description and find my course. It is a paid course, but it's very affordable for everyone. That will teach you what are options, what are crypto options, how you can make passive income from crypto options weekly, or you can continue here on this YouTube channel and just go to the list of my videos. There's a little search icon there. You just type options, and I have a couple of videos teaching you what are crypto options, what are options in general, and how you can make money with them. So I'm going to give you 2 seconds for you to go choose whatever you want to choose and come back here. Well, now that you have a little bit of understanding what derivatives, what options are, let me show you another case of arbitraging opportunities that we had, and you maybe even participated into this, or you've lived through this, which is the Terra Luna meltdown that we had last year. So long story short, we had UST and Luna. UST was an algorithmic stablecoin, and it was using Luna to reflect its volatility. So Luna was the one that was moving, while UST was being pegged to the dollar at the time. But if you remember, shit hit the fan and everything went downhill really fast. So what ended up happening is that the Luna token went all the way to zero. And that meltdown was so fast that people were seeing differences in value of the Luna token across multiple markets. Meaning that, for example, on the Terra ecosystem, the Terra network, you were seeing Luna at one price. And let's say on Avalanche, for example, Luna was way more expensive than the actual price that was melting down, because one price was not being reflected to the other as fast. So that created opportunities for people to arbitrage. This is just one example because, for example, all the Luna derivatives on multiple protocols, so we had B Luna, P Luna, different Luna tokens or derivatives of the Luna tokens, they also had different prices. So you could be getting, for example, P Luna and converting this P Luna back to Luna to make a quick buck because the price was not matching. It was not one-to-one anymore. So a lot of people were profiting from these multiple arbitraging opportunities. I even did some, I even posted some on Twitter because on Avalanche there was a huge discrepancy between the prices of Luna on Terra and on Avalanche. So a bunch of people did this, a bunch of people made some money. But these opportunities are rare, they are scarce. It is not always that you have a token that is melting so fast that its price is not the same across markets. Of course, there's usually some kind of DPEG, some kind of anomaly in price-wise because of different oracles across different blockchains, but it is not enough for you to be profitable by buying somewhere, bridging it, paying fees, and selling it somewhere else. So this is where options come in. Because with options, you get introduced to multiple variables that can help you with this. And because we have market makers, we have order books, we have AMMs. So this creates a whole lot of discrepancies between prices from protocol A and network A to protocol B and network B and vice versa. Mainly because there is a bid and ask, so you can see discrepancies in price in one place or the other, and this is where we start our journey to make money with arbitrage. But before I start spilling the tea on what are these protocols, where you can find these options, you have to understand that arbitraging with options, meaning that you are delta neutral, because you're gonna pretty much open a contract and close it for a profit. So you really are protected from whatever happens to the markets. I'm gonna give you some examples later on, but when you buy an option, when you buy a contract somewhere and you sell the contract somewhere else, they are the same expiration, they are the same strike, they are the same position, pretty much inverse. So when you do +1 and -1, you get a net 0. This is pretty much what option arbitraging is. You open a position and you open the inverse position somewhere else, meaning that if you bought, for example, a call, you're gonna sell that call somewhere else. Was that clear? If it wasn't, just go back, re-listen to that slowly, and you're gonna be able to understand. I know for some people who are not very familiar with options, it might get a little bit strange, but trust me, with enough time, with enough repetition, you will understand what I'm talking about. So where should you look for these options? Well, if you're reading my newsletter, by the way, quick plug right here, I post a newsletter every Monday, and usually this newsletter is a more in-depth version of these YouTube videos and threads that I do throughout the week. So if you want to know more about arbitraging, if you want to get deeper into arbitraging, scroll down. I'm going to leave the link for the newsletter also here at the bottom of the video or in the description, where you can join this newsletter. It's free. I'm not charging. I'm not asking for any money. And it's just a written, more dense version of what you're understanding here. So we're going to be actually adding one more to the list from the newsletter, just because today, as 3 hours ago from what I'm recording, one protocol just went live for the public. So everyone can join, everyone can test this protocol, and this might be another one that we should add to the list to have this opportunity for us to make money. So the list of protocols where you should be looking for, because mainly for liquidity reasons, popularity reasons, they are the big dogs of their league, and also because of the model that they run, for example, an AMM, I'm going to be listing these protocols. And these are not in any specific order, but we have Deribit, we have Bybit. These two are centralized, meaning that you have to go through KYC. These are not DeFi protocols, they are CeFi, so they have government regulations. Then we have Lyra or Lyra, wherever you want to say it, Premia, and then we have Syncode. These are the ones that I listed in the newsletter, and the new one is Aivo, whatever it is. It was created from the Ribbon team, so if you know Ribbon Finance, Aivo is a creation from that team, and it looks pretty good. I have to admit, I will place some trades there to test it, to feel a little bit how it works. It has the feel of a CeFi protocol or a TradFi brokerage if you're used to trading options on interactive brokers, for example, or any others. Let's see how it goes. So I'm just adding Aivo to the list because it might be just another opportunity for you to make money. So once you've made your accounts everywhere for the CeFi, you've made your KYC for the DeFi projects, you're already connected to these networks, you're ready to start the hunt. And this part is the worst, hunting for opportunities. So it is as easy as you can imagine, but it's also tedious because you need to be refreshing the page, opening one website, looking for prices, opening another protocol until you can find a discrepancy in price, a gap between prices from a buying to a selling position. So you need to be able to buy it for less and sell it for more. You need to be looking at these numbers. So let's say, for example, you are here on SyncQuote, you already have the whitelisted as I mentioned, and you are comparing these prices from SyncQuote to Lira. Here on SyncQuote, you have selected buy call for the 23rd and on Lira sell call on the 23rd. So now there is no current example, current chance of arbitraging, but I'm going to give you a little tip about this later down the video, so stay tuned for a tip on how to get the best deals. But for example, let's say here we have $70. So let's say this option right here, for me to buy it, it is costing me $70 rounded. It says 72 here, but just for the sake of the example, let's say this says 70. Then you go right here on Lira and you notice that now the 1700 is paying you $72 for you to sell it here. So basically you go back to SyncQuote, you buy it here for $70. So you pay $70 upfront and you have bought the 1700 option. Then you go on Lira and you sell the 1700 option. You already paid $70 and here you're gonna get 72. You're gonna receive 72 because you're selling it. So because you're selling it, you're gonna be net profit by $2. You're gonna have $2 in profit from this transaction. But here's the thing, you're not gonna get an option here because you bought it on SyncQuote. You're not gonna get an option showing in your wallet. You're not gonna get a contract showing in your wallet, and then you're gonna bridge that to Lira to sell it. No, you're just gonna be the selling position is pretty much going to be like a short position. You're not going to be using your contract, moving your contract around like it was a piece of paper where you bought it here and then you go to someone else, you sell it. No, you're going to have a bought position here and you're going to have a sold position here on Lira in our example. So these two positions are going to nullify each other and you're still going to keep the profit of that $2.40 that was the difference. This is why I have a lot of people that reach out to me because they're confused. Because for example, on the protocol where they bought, they have a green number showing their position that is going fine. And on the protocol where they sold, sometimes they have huge red losses because one side is going to be profitable and the other is not going to be profitable, because that's how options work. You're going to have fluctuation in price of these contracts until expiration. On paper, you're still profitable, but by just looking at each and every protocol by themselves, your position is going to be either very good or very bad. But again, if you sum all of these, you're going to be net positive, because basically one is nullifying the other, is deleting the other, and you still keep the difference in price that you pay for. So here we have three outcomes. In all of these three outcomes, you're still profitable. In the newsletter, I made an example with a put. I bought a put. So let's go with that example. When you buy a put, you are betting that the market's going to go down. When you sell a put, you believe that the market will stay at the current price or go up. When you're shorting a put, you are bullish. So let's say you bought a put and you sold the same put somewhere else. Case one is where the underlying assets, so the underlying asset of the contract, let's say Ethereum, goes down. So one side of the put, the side that you bought, is going to be very profitable because it's going to go deep in the money. And the other side of the put that you sold, is going to go deep in the red because it is deep in the money and you sold it. So the price that you sold it for is going to be lower than the current price that this option is. But because you already nullified the position with the bought side, you will be profitable. The second thing that can happen is that the underlying asset Ethereum stays at the same price or at the same range. So let's say I sold a 1400 put. Ethereum stays at 1750 for the whole week, and these puts that I bought and sold expire. So what will happen? The put that I bought on protocol A will expire worthless. So I bought it for $70 and I have a $70 loss there. On the other side, the put that I sold, I collected $72, and this one will also expire worthless. But I already collected the $72, so I lost $70 on the one that I bought, and I made $72 for the one that I sold, meaning that I have $2 profit. The third case is that Ethereum goes up, the underlying asset goes up. So we bought a put, again, the put that we bought was for $70, that one will expire worthless because buying a put means that you want the asset to go down. So that one will expire worthless, $70 in the red from this site. But the one we sold, actually now also expired worthless because Ethereum went up to, let's say, 2100, 2200, whatever it is. And this option, just like the bought side, the sold side also expired worthless. So we have a $70 loss on one side and a $72 gain on the other side, meaning that total, I have the $2 profit. So what if you have a daily job, or if you have more important things to do than to keep an eye on all these projects, on all these protocols every time of your day until you find somewhere where there's a discrepancy in price? Well, let me tell you, if you stayed all the way to this part of the video, I'm going to give you the secret tool that makes everything easier, everything simpler. And it is a tool called Straddle. The website is straddle.xyz. So straddle.xyz. Once you click there, you will see there's a tab called Arbitrage Deals. And let me show how that looks so you can get familiar with it. Once you get right here, look at the beauty. Here it lists all these protocols, all these markets that you can choose from. We can filter and add all of these different protocols. You can just select these. You can add everything for them to get a quote of the current price of these options. And here it will list for both Ethereum and Bitcoin the available opportunities that you have to open an arbitrage position. So right here we have, for example, a 1750 put for June 23rd, and on Bybit you can buy it for $23.80 and you can sell it on Lira on Optimism for $26.72, meaning there's a $3 difference that you can be profiting by opening this position. So Bybit is centralized, Lira is decentralized. Lira right here for this specific trade, Lira right here is on the Optimism network. So you might be thinking, this is too simple. Now that I understood it, now that I watched your video, thank you for enlightening me. This is too simple. I just go on Straddle, I find an opportunity, and I keep rinsing and repeating every day until I make millions of dollars. Well, this is where I need to stop, pump the brakes, because we have limitations here that I'd like to talk about. First limitation right here is capital. So this is very capital reliant, meaning that you need to have huge sums of money for you to be profitable. What do I mean with this? For example, when you buy an option, you're just gonna pay that price that is listed right there. So in our example, we paid $70 to buy that contract. We just need $70 in our account. We have these $70, you buy the option. Simple. But when it comes to selling the option, it gets a little bit harder, because for you to sell this option, it needs to be covered, meaning that you are going to need margin. You're going to need extra capital to be deposited there to cover for this option that you are selling. And of course, most of these protocols do offer margin, meaning that you can be leveraged on how much you need, on how little you'll need to sell specific options, to sell specific contracts. But still, you will need a larger sum of capital than just $70 to buy it. Let's say, for example, you spent $70 to buy a contract. You will need a full Ethereum to sell the same contract somewhere else, because you need to cover that position before you can sell it. Of course, some projects you might need less, some projects you might need more. So I'm gonna leave the math to you to decide, to you to check, because sometimes you might have arbitraging opportunities on a protocol that is very lenient and offers a lot of margin, so you can take huge margins and profit more. Or sometimes you're gonna have an opportunity on a protocol that does not offer much leverage and margin, so you're gonna have to deploy more capital, meaning that your ROI will be a little less. So these things need to be taken in consideration. There is a limitation, that is capital. The second limitation is mobility, meaning that, for example, we just saw right here an opportunity between Bybit and Lira, but Lira on the Optimism network, meaning that you're gonna go through that. You need to have $70 on Bybit, which is centralized, so it's going to be in its separate wallet. It's not going to be on chain, it's going to be most likely off chain. Okay, you have that $70 there, but then let's say you have money on your crypto wallet on Arbitrum, then you have to take that money really fast, bridge it to Optimism, which you're going to have fees to pay. So you're paying those $2-3 fees for the bridge, and then you're going to have to open the position, and the position usually comes with fees, transaction fees, gas fees, all these sort of fees that are adding up. So these fees, gas fees, bridging fees, protocol fees even, they add up. So you need to do the math on how much is too much. Sometimes it can be even unprofitable for you to open a position. I'm going to be getting 2% on this arbitrage opportunity, but then you're going to spend 2% of the total capital needed in fees. So you're going to be pretty much net zero on this position. It was a nullified position to begin with. So doesn't make sense. You need to do the math first. The third limitation is consistency. What do I mean by consistency? It means that, just as I said before, there will always be discrepancies in the market, but profitable ones for you might be rare. So sometimes you're going to have once a week an opportunity for you to arbitrage, but sometimes it's going to be once a month, maybe once every 2 months. Who knows? Because these discrepancies are not defined, they are very random. Sometimes you can have huge discrepancies where you're going to make 20%, 30% profits, but sometimes you're just going to have to be holding the bag and waiting for an opportunity to come. This is why I mean consistency is also a limiting factor here, because we don't know when the next huge arbitraging opportunity will come for us. Of course, that being said, this is not the only way people can arbitrage. I'm just showing you the arbitrage way with options. Of course, you can use options and perpetuals. You can arbitrage on a hold position that you are doing. So let's say you're holding Bitcoin and you find an opportunity somewhere for you to sell a position, profit, make some quick profits, close position, and move on. So there's a lot of ways where you can arbitrage. I just showed you the one with options. Fully using options, this is how you should do it. So this is why it is not a get rich quick way to make money. It is an easy way for you to make money, but it's not an easy way for you to grow your capital really fast. It is just a way for you to make money with almost no risks, because you're delta neutral. So in paper, you have no risks whatsoever when you open and close a position, especially with options. So I hope this was insightful. If it was, and you want to get a little bit more deep into this, again, the newsletter is going to be down in the description. Also the course where we talk about options. And if you have any more questions or interest, you can reach out down in the comments below or on Twitter. I'm always there, just DM me and we can talk more about these strategies or whatever other strategies with options that you would like to know. Again, thank you so much for watching, and I'll catch you guys in the next video. See you.